Imagine waking up one morning and your entire life savings have vanished. Retirement accounts wiped out. Millions lose their jobs overnight. Nearly $19 trillion of household wealth evaporates in months. This wasn't a movie. This was September 2008, when a 158-year-old Wall Street giant named Lehman Brothers collapsed with $600 billion in assets. The worst economic disaster since the Great Depression. But what if I told you the real cause started with one simple seductive lie you could fit on a billboard? Why rent you can own? It's the early 2000s. America is still hurting from the dot-com bubble burst and the 9/11 attacks. The economy is sputtering. To revive growth, the Federal Reserve slashes interest rates 11 times, all the way down to 1.75%, the lowest in 40 years. Cheap money floods the system. At the same time, the U.S. government is obsessed with expanding homeownership. They push legislation that forces mortgage giants Fannie Mae and Freddie Mac to buy more loans, especially from lower-income buyers. Homeownership hits a record 69% in 2004. Lenders loosen standards to keep the mortgages flowing. The message everywhere with billboards, ads, mortgage seminars is loud and clear. Why rent when you can own? Banks don't just agree. They go all in. They start handing out subprime mortgages to people with bad credit, unstable jobs, or no jobs at all. These are the infamous ninja loans. No income, no job, no assets. I lost my job. I'm looking for a small loan to pay rent. Perfect. You're approved for $600,000, and then hey, why not a second home? Adjustable rate mortgages with teaser rates, interest-only payments, balloon payments, anything to get people in the door. Down payments? Optional. Risk assessments? Forgotten. If you had a pulse, you qualified. Even baristas and McDonald's workers with $5 in savings were buying condos and flipping them weeks later. Real estate wasn't shelter anymore. It was a national obsession. Buy, flip, profit, repeat. Prices skyrocketed. Your neighbor's house doubled in 6 months. It felt like free money. But here's where Wall Street turns the housing frenzy into a global time bomb. Lenders no longer cared if borrowers could actually pay because they weren't keeping the loans. They sold them instantly. Investment banks bought mountains of these mortgages, bundled them together, and sold shares of the pool to investors as mortgage-backed securities, MBS. Homebuyers now paid investors directly. It was genius. Regular interest payments like bonds, plus if someone defaulted, you could seize the house. And with prices rising, what could possibly go wrong? Demand exploded. Global investors couldn't get enough of safe U.S. real estate. Fannie and Freddie supercharged it. Lenders printed loans like monopoly money. Brokers earned fat commissions. Everyone was making money. But the banks still weren't done. They took the shakiest bundles and repackaged them into collateralized debt obligations, CDOs, even riskier slices that somehow got labeled investment grade. Then they invented synthetic CDOs, pure bets on whether people would keep paying mortgages they couldn't afford. And the credit rating agencies? Paid by the very banks creating these toxic products. They used flawed models and stamped junk with shiny AAA ratings. This bundle is full of bankrupt baristas and unemployed gym bros. Looks AAA to us. Michelin-starred raw chicken, anyone? Meanwhile, insurers smelled easy profits and began selling credit default swaps, insurance policies that paid out if mortgages defaulted. You didn't even need to own the mortgage to buy the insurance. It was like taking out life insurance on your neighbor's grandma and quietly hoping she slips on the stairs. The notional value of CDS exploded from $900 billion to over $62 trillion. A parallel shadow banking system had emerged. Investment banks, hedge funds, unregulated players taking on bank-like risk with insane leverage and zero oversight. In 2004, the SEC quietly loosened the net capital rule. Investment banks with over $5 billion in assets could now leverage themselves an unlimited number of times. The belief? They can manage their own risk better than any rule book. Fatal mistake. By 2005, subprime loans made up nearly 20% of new mortgages. Interest-only loans let people live like kings on payments they could never sustain long-term. Global money kept pouring in. On the surface, the money fountain never stopped, but small cracks were forming. In 2006, the U.S. yield curve inverted, a classic recession warning. By 2007, home prices peaked, then began to fall. Suddenly, millions of borrowers couldn't refinance or repay. Defaults skyrocketed. Subprime loans were only 13% of mortgages but accounted for half of all foreclosures. Those safe as houses, mortgage-backed securities, and CDOs turned out to be financial plutonium. The dominoes fell fast. In early 2007, over 24 subprime lenders collapsed. In mid-2007, two Bear Stearns hedge funds imploded. Banks froze lending to each other. Credit markets went haywire. By early 2008, roughly a quarter of subprime mortgages had defaulted. Millions of homeowners were underwater. In March 2008, Bear Stearns neared collapse. The Fed brokered a fire sale to J.P. Morgan. On September 6th, the government seized Fannie Mae and Freddie Mac, but the worst was still coming. On September 15th, Lehman Brothers filed the largest bankruptcy in U.S. history. The next day, AIG needed an $85 billion Fed rescue, eventually over $180 billion. Credit markets froze completely. The entire financial system stood on the brink. Congress rushed through a $700 billion TARP bailout. The Fed slashed rates to near zero and began quantitative easing. President Obama later signed a $787 billion stimulus, but the damage was done. The waves hit Main Street hard. About 4 million Americans lost their homes. Another 4.5 million faced foreclosure. 8.7 million jobs vanished. Unemployment spiked to 10%. The stock market plunged nearly 40%. Global contagion spread instantly. Europe, Iceland, worldwide markets dropped 40 to 60%. The government had no choice but to bail out the very banks that lit the match. Wall Street got rescued. Main Street got pink slips and foreclosure notices. No major CEO went to jail. Golden parachutes were paid. Trust in the system burned to the ground. What did we learn? First, deregulation without guardrails is dangerous. Second, watchdogs failed spectacularly. Rating agencies sold AAA ratings for cash like it was a garage sale. Third, the Fed kept rates too low for long and trusted banks to self-regulate. Fourth, complex does not mean safe. Fancy risk models wildly underestimated how connected everything was. Financial innovation isn't evil, but forgetting what you're actually investing in is. The house of cards wasn't built by a few greedy bankers or unlucky homeowners. It was an entire system. Bad loans, fragile trust, negligence, and the blind belief that housing prices would never fall. The economy eventually recovered. Dodd-Frank added oversight, stress test, and the Volcker rule. Basel III forced banks to hold more capital, but the scars remain. And the next crisis? It won't look like 2008. It will look harmless, profitable, and inevitable till it isn't. So what's the big lesson from the 2008 financial crisis? When everyone chases easy money and ignores risk, the system eventually breaks. The cave of cheap credit and fancy financial products taught us that real oversight and understanding what you're investing in still matter. The hidden truth? In systems built on greed and leverage, the house always wins till the foundation cracks. If this story helped you understand how the world economy really works and how to protect yourself next time, smash that like button, subscribe, and ring the bell. We sketch a new big story every week in raw, hand-drawn style. Drop a comment. House of Cards. Do you think another financial crisis like 2008 could happen again in today's economy? Thanks for watching, friends. Stay curious about how the big pictures get drawn. See you in the next one.